Hey, welcome to another Coffee with Kirk. Hope you're doing well. Today, I'm going to chat a little bit about, kind of from a question I got on the last Coffee with Kirk. And a client asked, why are we investing in international stocks? And basically, the biggest reason is cycles. Cycles drive everything in markets and life. There's always different kinds of cycles going on. You could go all the way down to typically fashion and hairstyles and everything. Everything is cyclical. and I, nobody can tell exactly when things change, but you can kind of get a feel for when you've hit extremes on different cycles and when they should be changing at some point. And if you can kind of be in the front of that, you can do pretty well. So I'm going to talk just a little bit about that today. And as I always love to do, let's jump in and grab some slides. I always like to have my slides there. So we're going to kind of look at cycles from a lot of different things. U.S. stocks, specifically growth and value. We're going to look at international stocks, the U.S. dollar, commodities, active versus passive investing. Really everything is going to kind of be looked at. And what I'm kind of seeing with a lot of this is there's a lot of longer term cycles that at some point they're going to correct. And some of them are getting pretty extreme. So one of the big reasons, just to jump right back to the international question, is international stocks have really underperformed for a long time. And at some point, they're going to outperform U.S. stocks because that happens. There are periods, decades-long periods where that happens. So let me just start in with a little bit of the background on the U.S. stock market. So obviously had a heck of a run since 2009 with U.S. stocks. And one of the big reasons is we've had really great corporate profits for quite some time. And this is just a chart showing you the U.S. corporate profit percentage compared to the gross domestic product of the United States. So when you look at this, I mean, typically between 6 and 8% is where most of history has shown that's where companies are. There's periods above that and periods below that, but roughly the main line here, that's 6%. You're going to really rotate around that. But you can kind of see since the tech bubble, or not tech bubble bursting, but the credit crisis of 2008, we've been substantially higher than that. I mean, substantially. Several standard deviations above that 6% line. And the thing is, that can only hold so long. And even back in 1999, Warren Buffett, when everybody was talking about the higher profit margins and saying they're going to stay because it was tech driven. Like tech doesn't have to. They have higher profit margins because they don't have factories and lots of costly assets they have to buy, which creates liabilities. And, he said back then, look, anytime you get much above 6%, it's wildly optimistically that they could stay there. And he was right. And that's exactly kind of what happened. You can kind of see at that period there, roughly, if you look at the chart, it's not perfectly in line there, but you can kind of see when things, they went below the 6% line after the statement by Buffett. And I mean, we're way above that right now. So either you have to believe that, okay, maybe it's the AI, maybe it's tech again, that just has extremely high profit margins and it'll stay that way. But the thing is, the companies with the highest profit margins, well, they end up drawing competitors because if you're making so much money, you're going to get competitors. Any kind of company that comes out and is killing it, you're going to get a replica. When McDonald's was destroying it and changing the way Americans eat, up came Burger King and Arby's and all of those. And the same thing is going to happen here, even with technology companies. And then it kind of brings down those profit margins. And the thing is, when you have the profit margins like we do now, we end up getting people to bid up stocks probably well beyond what they're truly worth. Definitely beyond what they're worth if profit margins were near historical averages, around 6 to 8%. And this, again, is something that kind of Buffett pointed out during the tech bubble. And he said, you're expecting too much from long term. He goes, there are periods in recent U.S. history where America's economy doubled, tripled, or even quintupled in value, yet the stock market went nowhere because it had already been so overpriced to begin with. And this is still talking about 99. Buffett acknowledged the white-hot performance of the market in recent years, but this should make investors cautious. Over time, he warned reality would catch up with lofty valuations. And that's kind of where we've been. And it's mostly in the growth sector, and specifically in tech. One of the big trends that, it's been going on for quite a while is just growth stocks. So you're talking a lot of technology, but just companies that are growing fast. It could even be a new franchise, a restaurant franchise that's growing extremely fast, adding tons of stores and seeing revenues and earnings grow. So it's not necessarily just tech, but for the most part, when you dig into it, it's going to be a lot of tech. So since 2009, this is just a sort of growth compared to value. You can just kind of see that the growth of a portfolio. I mean, right now, growth has exceeded values returns since 2009 by 124%. So, I mean, that should give most investors a little bit of alarm. This is just sort of another way to kind of look at it. And what this chart shows you is anytime you're below that little dash line at 1, it means that's where you want to be, definitely invested in growth. And then anytime it's above that, you definitely want to be invested in value stocks. Now, if you look at the top of the chart here in the value, the really big spike up there, that was 1999. So again, at that point, I'm going to ask you to go back to 1999 when everybody at the parties and on TV, and it was all about the internet stocks. Anything that was basically internet got a really lofty valuation. Well, it would have been awfully difficult for you at that point to say, I'm going to go into some more boring value stocks. So value stocks are either stocks that have kind of either been beaten down, so they're good companies, but maybe some missteps have caused them to get beaten down, or they're just traditionally larger companies, very solid cash flows, very good dividend yields, boring stuff, like a Clorox or Kimberly Clark, or, really just companies have been around for a long time, really boring, not sexy in any way, but they just keep driving the cash flows to their investors. So it would have been difficult for you to basically say, I'm not going to invest in the internet stocks. I'm going to go back and invest in some boring consumer staples and utilities and things like that. But you can kind of see from the chart there, boy, you would have been well rewarded had you done so. And where we're at right now is not any kind of crazy difference like it was back in 99 between value and growth, but it's still sizably above kind of the historical average. And if you look at this and start to say, well, I don't know if it's going to happen today. I don't know. It might go a couple more years where growth continues to dominate. But there's definitely a cycle getting closer to the end than it is at the beginning. And this is just one final chart showing really long term, going back to the 1920s. and kind of comparing if you had invested in a value portfolio relative to the growth. So really from after World War II up until, probably in the 90s, that's when you saw actually value outperform growth long-term, really a long-term. So back in 26, when this chart started, if you had 100,000 in value, 100,000 in growth, you've been much better off being in value, really up until recently. And then, growth has really taken over on that. And let me jump to a different, I'll go back here. So sticking with this trend and now looking at the market in general, the United States essentially has the second most expensive market right now based on earnings in the world. So we're at a very lofty valuation, very expensive market. Again, when things get a little too expensive, typically you're going to see trends reverse. You're going to see long-term cycles take effect. Right now, looking at the market in pretty much every general way, this is just looking at forward earnings right here. So this is what we're expecting to have in earnings over the next 12 months. So we're the second most expensive market based on projected forward earnings. Nobody knows what earnings are going to be going forward, but that's on projected forward earnings. And then looking at price to book, this is sort of the valuation of the market today based on the price to book. This is U.S. stocks. And so what's price to book? Again, book value of a company is simply your assets minus liabilities divided by the number of shares that are outstanding. That's all it is. So it's really just looking at your balance sheet. So it's not so much on earnings, it's more on your balance sheet. And even relative to balance sheets, we're at all-time highs here. So you have to start to think, is this thing going to turn a little bit? And then there's a figure that I always like to look at, and it's called the Buffett model or Buffett signal. And what Warren Buffett looks at is he takes the total value of the stock market capitalization. So all of the publicly traded stocks on the market, take the total value of that and divide it by the GDP or the size of the economy. And remember, we talked about this previously, but the vast majority of the GDP is made up and constructed of small to mid-sized companies, most of whom are not publicly traded. So when you're looking at just the publicly traded stocks and their total value relative to the economy, it gives you a pretty good signal. And usually anytime you start getting above 125%, that shows that you have an overvalued market. Well, I mean, right now we're at 200%. So that means that the total stock market valuation out there is twice the size of the U.S. economy. That's awfully high. And what you really want to do is you want to be buying when we get below 80%. That's a really great time to buy. Another valuation, just to show you that the market, by pretty much any way you look at it, is overvalued. This is the CAPE ratio. This is cyclically adjusted price to earnings. That's what CAPE means. And this was developed by Nobel economist Robert Shiller. And what he does is he takes the price to earnings. So again, that's just the price of the stock or the stock market in general, and divide it by the earnings, the aggregate earnings of the stock market. And rather than looking at 1 year's data or forward 12 months or anything like that, he just takes the past 10 years of earnings and averages that out. What it does is it smooths the number out a little bit, because year to year, things can be awfully volatile as far as earnings. But when you take it over a 10-year period, typically you see a more smooth trend. And you can kind of look at it here. While we're certainly not at the peak that we were back in 1999, early 2000, when it hit just shy of 45, we're awfully high. We're at 36. I mean, historically, if you take that 1999 jump up and you take that off the graph and you look at it today, you'd be like, whoa. I mean, we're way above anything previously, including the Great Depression. So we have some really high valuations right now. And the thing is, like I showed you the Buffett quotes earlier, it does have an impact on your future returns. So this is the cyclically adjusted price to earnings based on the current valuation, and then what do you usually get in the ensuing 10 years as an investor. So the bottom part of this graph is the CAPE ratio. So the further to the right we go, the higher it is. And again, remember, we're at 36 right now. And then if you look on the y-axis, you get the average annual S&P return. So clearly, the higher up you go there, the higher your return is going to be over the next 10 years. So it's going to say, what do you get on a each year annual basis for the next 10 years? So you see there's a really strong correlation. The lower the Shiller PE ratio is, the higher your ensuing 10 years return. And where we're at 36 right now, it's basically saying, well, we're probably looking at maybe a 2% annual return in U.S. stocks over the ensuing 10 years based on valuations. Doesn't mean it's going to happen right away. The thing is, the old saying that the market can remain irrational longer than you can remain solvent is absolutely true. But there's definitely something to this as far as what you could expect as an investor. This is just a kind of another chart showing you the same sort of thing based on cash flow, price to cash flow. So cash flows, base essentially all the money that's being generated by companies. And again, we're really high on cash flows, and there's clearly something that is showing you that the amount you're paying for those cash flows when you buy the stock has a huge impact on your ensuing 10-year returns. So this chart shows you essentially in February of 2009, when everybody was afraid to buy into the market, well, that was the absolute best time to do it, because based on what investors were paying for company cash flows was very, very low. So your ensuing 10-year returns were over 18%. Right now, this graph's a little dated. It's September of 24, but you can kind of see the little angle there in the far right corner. Yeah, not real good. So kind of based on that. So it's saying what we're paying right now for cash flows isn't really justified in the U.S. market. Now, taking all this back and jumping back to our value versus growth, over the long term, value has always kind of trumped growth. And the reason is, growth can be fleeting. You could have a company and it's really doing well, and then all of a sudden that growth slows down in any fashionable way. And you probably have a very high valuation, because when you were growing quickly, investors assigned they came in because you're growing, and it assigned a very high valuation. And then when things slow down, you're overvalued based on a slowing earnings, slowing revenues. I kind of think that's what we're seeing with Tesla right now. I mean, really, for the past 3 years, Tesla's revenues have been flat, and their earnings are actually gone down. Now, everybody will scream at me and say, "Well, they're coming out with robo taxis. They're doing stuff on the energy front, starting to develop AI and all that." It's like, well, yeah, I mean, but it's trading at 188 times earnings right now. So you got a company that's flat on both growth, on its growth, and maybe things will take off, and we'll all be in robo taxis here in the next year, and they'll make a ton of money. But you're really paying a lot, and you have huge expectations. If this thing doesn't go gangbusters in the near future, you're going to be in trouble. So anyway, typically, maybe it's the tortoise and the hare story that, the tortoise is going to win, the solid value companies that are boring, that are just generating tons of cash and earnings and giving it back to the clients via dividends. But over time, that does work. And if you go all the way back to 1926 through the end of 24, value has beaten growth 59% of the 1 year returns. So if over all those years, 59% of the time value won. But if you take it over a 5-year period, now it's 69% where value beats growth. And over a 10-year period, 77% of those 10-year windows value beat growth. But now we've been in essentially a 15-year situation where growth has beaten value. So you can either say, well, it's going to continue and invest in growth, or you can start to say, look, this cycle, it's got to turn at some point, especially based on data going all the way back to 1926. So what do you do? Well, when you get to points like this and you have market valuations like they are, especially extremes in growth relative to value, you go back and you kind of look at what you want to invest in. And there are sectors you definitely want to be focused on. So what this is kind of looking mostly at dividends here, but you could also kind of argue it gets into valuations too. And you can sort of see it's looking at each 10-year period here off on the far left. So it starts at January 1930 to December 39 and takes us all the way. The last one is just from January 2020 to December 24. A little bit different, a little bit shorter window there. But you can kind of see we're just looking at different decades. So obviously January 1930, what had just happened then? Well, we just entered the Great Depression. We were 2 months off of the first initial part of the stock market crash. So from 1930 to 1939, where should you have invested is probably the big thing. And what this chart does is it gives you the S&P 500 index overall. So if you just invested in the market in general, and then it takes all of the S&P 500 companies and breaks it into 5 quintiles, 5 groupings. The first quintile is the highest dividend paying quintile, second quintile, and then third, fourth, fifth. So fifth is not paying much at all in dividends. And you can kind of see there's a definite cyclicality to all of this. So in the 1930s, oddly enough, though, the first quintile then with the highest dividend payers actually delivered a negative annual return there. And the second quintile was positive. And then growth stocks, the fifth quintile, lowest dividend payers, also did well. It's interesting there. But as we start to come out of, so 1940 to 49, the S&P 500 delivered about a 9.5% return. But clearly, you would have been much better off invested in dividends at that point. The first 2 quintiles really crushed it. And then the other sectors or other quintiles trailed it. Same for the 1950s, if you went through those periods. Now, what do we see in those periods? Well, coming out of the war, we had very low valuations. Basically, because we lost 80% during the 1930s. But you can clearly see that investing in kind of the solid cash flow companies that were delivering dividends did much better. But then we started to get back, okay, so we get in the 60s and the 70s, and you start to see the fifth quintiles do definitely better in the 60s as we started to get some growth back. That's when growth stocks had a very good decade. If you're around then, you might remember a company called IBM. That was kind of their heyday back then. They had something called the Nifty 50 during the 60s. Those were the 50 stocks you had to be invested in. It was almost like the internet stocks of 2000 and really the AI or Magnificent Seven of today. But then we got, back into the 70s, You might remember 70s, we had two bear markets in the 70s, the early, 73, 74. And then at the end of the 70s, another one. So if you look there, where did you want to be after a period of really good growth, where growth dominated in the 60s? Well, it was back in the higher dividend paying companies. They were the ones that were outperforming for sure. Even into the 1980s, if you look at it, the 80s were pretty solid throughout, 16.8% overall. First two quintiles outperformed it, but even the fifth quintile had a 15%. So 80s were pretty good no matter what. But what did we have in the 80s? Well, early part of the 80s, again, recession in 81. We had really high interest rates. When you have high interest rates and inflation in the beginning of that decade, people typically want cash because your purchasing power is going away. You need cash. So that kind of held, people wanted dividends. So they did much better. But then we get into the 90s. And if you look at it there, definitely a growth phase, right? 1990s, that's when tech really came about. And, we saw a huge uptick in growth relative to value. And that's the best place to be was companies that weren't paying the dividends. They were just a growth story. But of course, the hangover from the tech bubble hit, and you can kind of see what happened. Well, dividend paying stocks did better from 2000 to 2009. But since then, we are back to the point where we're kind of seeing growth do much better than value. So I guess the big takeaway here is when you get to the point where growth has exceeded value, you want to look for companies that are delivering shareholder value immediately to you. Dividends is definitely one way to look at it. You want higher dividends. It could be other things. We call it shareholder value. It could be they're paying down debt or they're buying back shares. That also helps you. But you want to go back to those kind of more boring companies that are steady cash flow producers. And this cyclicality in stocks happens also between the U.S. and international stocks. This is just kind of a graph showing you sort of year to year where U.S. and international stocks saw outperformance or underperformance. If you look at this chart in the 1980s, U.S. underperformed relative to global stocks by 51%. If you remember what was going on in the 80s, Japan, right? Japan was the rage. Everybody wanted to be in Japan. So you had that period where that was what outperformed. And then really basically through the 90s, you had U.S. stocks crush international by about 29%. But then when the tech bubble burst, you had a decade where you would have been much better off being in international. Since 2009, roughly, you would have been much better rewarded as an investor if you had been invested in U.S. stocks. And the thing is, a lot of people say, well, yeah, but the U.S. is always so much better than international. It's more dynamic economy, more free market. How could you say this? Well, this is based on earnings. So even if you're talking about a less vibrant economy in France and Germany and Spain and Italy, but it's companies with their actual earnings, the cash that comes back to you as an investor. What's the valuation of those earnings relative to what the valuations are in the United States? So at the end of the day, what you have to remember is you get compensated as an investor if you buy assets on the cheap, even if those assets aren't quite as dynamic as other companies. The key is you are investing to get earnings. If you buy a rental property, you want rents to come to your pocket. You don't care if it's a vibrant community. If you're not getting the rents, it ain't a good investment. Same thing here. We're looking mostly, the cyclicality is based on valuations. Again, this is just another chart showing you periods where international outperforms and periods where U.S. outperforms. So, we've had 14 years now where international has lagged U.S. stocks. Are we due for a change here? I mean, history would say yes, but it doesn't mean it's going to happen right now. But when you start to look at valuations, it makes a lot of sense. So this is comparing the Vanguard Total Stock Market Index, which is U.S., compared to the Vanguard Developed Market Index, which is developed international. So we're talking Western Europe, Japan, Korea, Australia, New Zealand. So developed. We're not talking the emerging markets here. But you can kind of see price to earnings. Again, based on actual earnings, you're paying substantially less to get that. The price relative to assets minus liabilities, the book value, way cheaper. Price to sales, way cheaper. Price to cash flow, 40% cheaper. And the dividend yield. So if you, again, going back to that graph where periods where dividends do better than non, you're getting double the dividend rate in international markets relative to the U.S. The other big thing that's going to play a factor into the international U.S. and also, which I'll talk about in a little bit, is commodities, is the dollar index. So again, cyclicality in life and cyclicality in markets, it's always there. This is sort of a chart of the U.S. dollar index going back to 2011. You kind of see right now we're hitting a long-term trend here. So either we're going to see the dollar bounce back up and gain strength here, or we could see it break this trend and we'll see where it goes, but it's got some serious downside if that happens. And this is just a chart, again, showing the US dollar cycles. You can kind of see periods here. What you usually end up finding is when the dollar drastically loses value, you end up getting a cheapening of the US stock market. So when the dollar hits its low on these bigger cycles, that's when you usually want to jump into US equities. When it's at the highs, as you can see, the tech bubble and kind of where we're at now, that's when you sort of want to avoid stocks a little bit. But based on where we're headed, if we break through that chart I showed you previously, that trend line, we might be having a period where the US dollar could depreciate or lose value relative to other currencies. We could lose 10, 20, 30% from here. And that is what the Trump administration is desperately trying to do, to try to make sure that we can sort of rebuild our manufacturing base here. So if they're successful in getting that done, we're going to get a period where it's going to be some serious headwinds for US stocks, relative to international, I should say. And we're going to see the dollar get weaker, which is going to be inflationary. So since that's going to be inflationary for us, because if our dollar is losing value relative to other currencies, that means we're probably going to be facing some inflation. And where's a great place to go if we have inflation? Well, that's going to be commodities. And what I'm going to show you is just sort of a couple quick charts that, we also have that bigger cycle looking at stocks to commodities. The first one here is just the stock to gold. So we're only looking at gold as the commodity. So you can kind of see right now, this is the Dow Jones Industrial Average divided by the price of gold. And we have broken a 45-year trend line recently with the great movement in gold. So you can also look, if we were to get back to where the last time gold sort of ruled supreme back in the early 80s, obviously when we went off the gold standard in 71 with Nixon, that next decade was unbelievable for gold. If we get anything close to that, you still have a period where we could see substantial movements in gold relative to stocks. Again, cyclicality. Cyclicality is the big thing to look at. Even if you wanted to ignore that 45-year trend line and you just go back to, say, 2001, gold has closed that gap considerably since then, but it still stands that it could continue from here. And the same for commodities as well. So we're seeing a long-term trend, kind of come to the end here. At least it looks like it. It could continue for a little while, but we're at extremes. And historically, these things do turn, they change. Cyclicality is the key. So you sort of see the peaks of, equities, the Plaza Accord, the tech bubble, and then they label it here tech bubble 2. And then you can kind of see commodity bottoms. So anytime we sort of hit a top on U.S. equities and it's come down, especially dollar weighted, commodities usually has a pretty good run. And we're at a point right now, commodities have kind of, they haven't been horrible investments recently, but they definitely haven't kept up with U.S. equities. But we're getting at extremes, and we're starting to think, well, is there a cycle here? Is there something that's changing? This is a pretty interesting chart going back to 2007, and it shows you the annual returns for commodities, gold, and the S&P 500. So stocks, U.S. stocks. Interesting things. So 2007, U.S. stock market struggles. Commodities and gold had a great year. 2008, both commodities and the S&P 500 struggled. Gold held its own. You can kind of see then going after, we've definitely seen some outperformance from the S&P 500. That blue bar, for the most part, in most years is substantially higher than the other two bars. So again, if you're looking at cycles and markets, while I don't know if this is the absolute bottom and things are going to change here, but we're definitely getting to some extremes where things usually do change. And you could even apply this to something called, passive investing versus active investing. I was always, if you go back and you could find things I've been writing since the 90s, when I first started working at the Motley Fool, and then when I went off, worked at a small firm in Palm Harbor, Florida. And then my early writings, I was passive. You got to be passive. There was really no proof that active was going to substantially, beat passive investing. And, I still use mostly broad-based passive ETFs. This chart just kind of shows you, it's based on ETFs. We're at the point now where that message has gotten into the public lexicon, that passive instead of active management. And everybody is passive now. We have more in passive money than active money. And again, the contrarian in me says, is there a cycle happening here? And this, you can kind of see the amount of money, the inflows in passive versus active management. Going back to 2014, it's all been passive for the most part. I mean, passive has absolutely dominated the amount of money instead of going into active. And a big part of that is the Department of Labor has started to crack down, or has been cracking down on 401k plans that had excessive fees. So a lot of companies just threw in, Vanguard funds or other low-cost passive investments just to cover their tail so they can't get screamed at for having excessive fees. So it's part of that, but it's also just that's where people are throwing their money. You have robo-advisors that have come out and they use strictly passive strategies. So if historically passive has done better than active, then why would you want to think of anything different than that? Well, again, it's kind of looking at it from cycles. If everybody's doing passive, well, that ends up creating some inefficiencies in the markets themselves. If all the money runs to passive investing, you're losing price discovery. When you had more active managers, they would all look at cash flows and profits and balance sheets, and they try to make determinations. So you end up getting more active movement on stocks, which when there's more people looking at this data and making changes, you get better price discovery. The price you're looking at is probably closer to the actual real value of the stock. Well, when everybody's going passive, what you end up doing is you are creating a momentum-driven market. So the stocks that have some momentum, just get more and more, and they get bigger and bigger. That's how we have the Magnificent Seven making up 23% of the S&P 500. Even though there's 500 stocks, 7% of them are making up, 20% of that. And you don't really get good price discovery, and you're not getting that fundamental, that the rebalancing. You go from growth to value. You go from U.S. to international. That's not happening. But the thing is, when this thing turns, and again, if you believe in cycles, everything will turn. We're going to see this probably happen. And that's one of the big reasons why I kind of merged in with Cale Smith. We created Bastion. We're still going to have, we have what we call a core and explore strategy. So the core of the portfolio is going to be, in passive, low cost ETFs. But we're going to have an explore strategy that looks at some of these cycles and looks at the underlying companies and looks at their profits and their cash flows and tries to say, is the market mispricing this stock? And so we'll have some active management there to try to exploit these trends when they finally do turn. And then the final thing I'll just talk about real quick is sort of bigger term trends. And these should scare you a little bit. They have me kind of worried. I mean, I don't know about you, but does it feel like society is a little bit crazier than it's been, in decades? If you go back to the 1980s and 90s and I told you the stuff that's going on today, you probably wouldn't have believed me. Well, what's interesting is that I've talked about this. I've done a whole podcast on this, the fourth turning. It was a book written in 97 by two gentlemen. And what they looked at was generational trends. And they started to find that there was pretty clear trends amongst every generation that's there. And these things lead to similar world events, right? So we're talking about things happening, cycles taking effect. And they said the fourth turning means every fourth generation, you have a very strong turn in society. And they went all the way back, started their study with the revolution. And then 4 generations after that, what did we have? We had the Civil War. 4 generations after that, what did we have? Well, we had the Great Depression and World War II. And unfortunately, right now, we are faced with a fourth turning. We're the 4th generation away from World War II. So in all of these things, you have the last turning where we're in now is really disruptive. It shakes the foundations. It affects everything from markets to society in general. But the point is, you come out of it and you have a golden age, right? Coming out of World War II was probably the best time to be in America ever. So the authors are like, that's what's going to happen. And you have to remember, they wrote this thing in the 90s. And Neil Howes, who was one of the authors, Neil talks about how, back in the 90s, when they came out with this book, nobody believed him. They looked at the times, like, things are great, right? The markets were booming. Society was, I wouldn't say we're necessarily just together, but clearly there wasn't the craziness going on that we had happening before. So, and now when he talks about it, when Neil talks about it now, what he says is people can't believe that we're going to actually come out of this. Like they look at the craziness that's happening today and say, this is going to continue on. But he's like, no, it's going to get better. So nobody believed him when he first came out of the book, and now nobody believes him when he says we're going to come through this thing. But kind of has me a little nervous is, there's a lot of trends out there. I'm not going to get into all of them. This is a pretty good book here, How Countries Go Broke. And this is Ray Dalio, who's a very famous hedge fund manager. He just looks at essentially debt cycles and says, I don't think anybody here, I have to convince you that we're kind of at a bad situation regarding our debt. And what's kind of bad is the fourth turning and debt cycles are kind of coming together, and that typically does happen. But there's like 3 other cycles that I've read, 100-year debt cycles, and so a lot of these theories and cycles, and they all seem to be converging here today. It's almost like the book The Perfect Storm. What made it the perfect storm is you had 3 horrible weather patterns all converge together, and it seems like we're definitely getting to the point where we're going to have a debt cycle coming here, along with what typically be a generational fourth turning. So it could make for a toxic brew. But again, remember, they said you come through it. You come through it. But the other thing, I think what you have to do as an investor is look at, okay, what other cycles are happening? So, maybe the weather won't be quite as rough if you're in international stocks or if you're invested in commodities. Because if we have a debt cycle crisis, we're going to end up with inflation. So maybe you do better if you're in gold and commodities. Definitely, if you're going to invest in the U.S., maybe looking at value, look at companies that pay better dividends, that lower price to book, things like that. So throwing your money into passive investing vehicles or throwing your money into AI stocks, which has worked well here the past few years, maybe that's not the path that's going to work going forward. So we'll see. I just thought the question that was asked at the last Coffee with Kirk, I thought, well, let me explain why I've got international, and I'm adding a little bit more to it. It's cycles, it's valuations. That's the big thing. Yeah, good comment from Rob. So there's always a cycle going on. It's where are you at in that cycle? And hopefully what I tried to show you when you look at certain investing cycles, and the ones I'm looking at, we've got some very big deviations that usually we're at a point where they start to correct the other way. And, I've been wrong. Last year I didn't do anything in the tech stocks, and they still did really well. So this doesn't give you any kind of input as to what's going to happen this year or next year. It's the bigger trends. And it's looking at from a risk standpoint. There's a lot more risk if you're investing in large cap growth than there's ever been. So, maybe it's smart, even if you drag a little bit on your portfolio, to be in more value, more international, more commodity, gold based, because when these things do turn, they're probably going to turn pretty quickly, and they'll definitely reward the investor that is ahead of the rest of the markets. Okay, so I've been jabbering on here probably long enough, but hopefully you can kind of see where I'm coming from when I talk and some of the investment moves I'm making. I do appreciate that I got that question last time. If you have questions, please send them to me. I love to base these on client questions, because I know if one client's thinking it, there's a lot of other clients that are. Okay. Well, I hope everybody has a phenomenal weekend, and we'll talk to you all soon. Take care, everybody.